Try again now. Morning, everybody. I'd like to introduce everybody to the LGPS Central Joint Committee today, 2nd of February 2024. First item on the agenda is the retirement of the chairmanship by Councillor Hogg and the appointment of the new chair and vice chair. The appointments are in accordance with the schedule of committee chairs that's been agreed by the partner funds previously. So the committee would like to pass on its thanks to Councillor Hogg for his chairmanship. So we'd now propose Councillor Barclay of Leicestershire as chair and Councillor Sutherland of Staffordshire as vice chair. And if we could just have a vote of the committee to approve this. Show of hands, thank you. So I'll now hand you over to new chair, Councillor Barclay.
Good morning, everybody, and thanks for attending today. It's good to see you all in person. I think you all look very different in person than you do on Microsoft Teams. You look younger, which is more than going to be said for me. So this meeting is going to be recorded and it'll be made available on a YouTube video as well. So just for your information, what I'm going to do to begin with, I'm just ask you to briefly introduce yourselves, starting on the front row on my left, your right, coming round, and then we'll go around the back. So if I can.
Ashko O'Hara, Director of Responsible Investment at LGPS Central.
Gordon Ross, CIO, LGPS Central.
John Burns, Interim CEO, LGPS Central.
Cara Forrest, Head of Clients at LGPS Central.
Thank you.
Adam Nelson, Assistant Fund Manager, Derbyshire County Council.
Councillor David Wilson, Derbyshire County Council.
Rachel Howe, Head of Governance, West Midlands Pension Fund and Practitioners Advisory Forum Chair for the purpose of this meeting.
Elizabeth Eyre, Worcestershire County Council.
Sharif Lutfi, Head of Pensions Investments at Worcestershire County Council.
Councillor Miles Hogg, the Chair of the Cheshire Pension Fund.
Lovely. Thank you.
Stephen Wilcock, Head of the Cheshire Pension Fund.
Tamsin Rabbits, Investments Team Manager, Nottinghamshire Pension Fund.
Councillor Eric Kerry, Chairman of Nottinghamshire Pension Fund Committee.
Leanne Tees, Internal Audit, Staffordshire County Council.
Deborah Harris, Chief Internal Auditor, Staffordshire County Council, and for the purposes of this meeting, the Chair of the Internal Audit Working Group.
Good morning, Melanie Stokes, Assistant Director for Treasury and Pensions at Staffordshire County Council.
Good morning, Mike Sutherland, Chair of Staffordshire Pension Fund.
Hi, Bulesh Katra, Leicestershire County Council Pension Fund.
Malcolm Cantello, Trade Union Representative from Unison.
Susan Martin, Non-Exec Director, LGPS Central.
Joanne Seegers, Chair of LGPS Central. Good morning, everybody.
Tom Biggins, Chairman of the Shropshire County Pension Fund.
Good morning, Justin Bridges, Head of Pensions at Shropshire County Pension Fund.
Right, thank you all for that. So the next item is apologies for absence, and we have received apologies from Councillor Jaspal. As far as I'm aware, there may be people viewing this live, but we haven't got anybody partaking via Teams. So we are there. The meeting is called. We've got plenty of people here today. So declarations of interest. Has anybody got any declarations they would make to make? Mr. Cantillo.
Yes, Chair, just to declare my interest in Unison.
Thank you. So the minutes of the last committee meeting are ready for approval. Does anybody have any queries or questions on that? I know that Councillor Kerry asked if the company-wide weighted average performance against benchmark could be reported. Gordon Ross responded that this information was not available at the committee last time, but would be provided at a future date. Gordon Ross of LGPS Central is able to provide an update either now or at the part of the company's presentation. The company provided some relevant content in their presentation on item 11. So Mr. Ross will refer to that in his response. Has anyone?
Yes, that's fine. Thank you. It's in the appendix pack, but I'll refer to it during my part as well.
Okay, that's fine. Yeah. So I ask, are the minutes approved then? That's everybody. Yeah, that's unanimous then. So we have 3 questions from the public. These have been published in our supplementary report pack. I will read the questions out and then I will ask Chris to read the answers out. So the first question received from Mr. D. Plunkett on the 7th of January this year. In paragraph 9 of the 2023 DLUC consultation, next steps on LGPS investments, the percentage transferred from the 8 partner funds to LGPS Central was 30%, which was identified as the lowest of all the pools and contrasted with LPP at over 80%. In respect of LGPS Central response to the consultation, the company has published on its website and can be found in the consultees section of the news channel. Okay, so I'm actually reading the response, so I'm now over to you, Chris.
Thank you, Chair. So the company's response was published on its website and can be found in the consultation section of the news channel. Various meetings were held with the partner funds where the company's position was discussed. Partner funds received a copy of the company's consultation response ahead of submission to DLUC. The response is reflective of the company's views and each partner fund submitted their own individual response.
Thank you. So question number 2 was received on the 15th of January 2024 from Mr. D. Channon. The FCA policy document PS23/16 signals that the UK will implement rules on sustainability, disclosure requirements and investment labels to ensure claims on ESG are honestly and fully disclosed and to prevent greenwashing by funds. Similarly, in France, the term responsible investment will not be allowed from 2024 for any funds that invest in fossil fuels. The LGPS Central Climate Fund invests in fossil fuel companies and gambling, tobacco and arms companies. Will LGPS Central divest such companies from this portfolio voluntarily before the UK ruling forces them to do so? So over to you, Chris, for the answer.
LGPS Central maintains that stewardship is a superior approach to driving change in the real economy compared to divestment. Regarding equities, divestment would resemble trading out of a position rather than directly withdrawing finance from a company, as our investments are secondary finance. Thus, stewardship remains integral to our climate strategy. We believe climate change is a complex challenge requiring a nuanced response. Fossil fuel companies possess the resources, expertise and incentive to contribute to this response, and this contribution is essential for a successful and just transition. Regarding regulation, there are no signs that the UK Chancellor and HM Treasury or the UK's leading opposition party plan to restrict the investment universe of UK pension schemes or follow the French Finance and Economy Minister's announcement. Any such decision would be political rather than regulatory. UK regulations focus on representing and clearly labelling investment strategies and products concerning sustainability, without mandating divestment from fossil fuels or any sector. Divestment would not decrease the demand for fossil fuels, which can only occur through technological and policy changes, driving clean energy substitutes mass adoption, a focus area for stewardship.
Thank you. And the final question was received on the 28th of January from Ms. J. Blackman. Carbon Tracker's recent report, Loading the Dice Against Pension Funds, see pages 1856 to 57, reveals that many pension funds including some in the LGPS central pool, use investment models that rely on the economists' flawed estimates of damage from climate change to predict that global warming of 2 to 4.3 degrees centigrade would have only a minimal impact on member portfolios. The report made it clear that these flawed economic models cannot be reconciled with warnings from climate scientists that global heating on this scale would be an existential threat to human civilization. To illustrate the failure, the Carbon Tracker report referred to the Mercer's investment modelling and give us, as an example, the climate scenarios and modelling produced by Mercer for Shropshire County Pension Fund's Climate-Related Disclosures Report 2020, see pages 10 to 11. Will the LGPS Central Joint Committee now urgently follow Carbon Tracker's advice to look at compelling evidence in the climate science literature and to impel investment strategies that are based on a rapid wind down of the fossil fuel system and on a no regrets precautionary approach? 2, find new investment consultants who use investment models founded on contemporary climate science and which assume the need for a rapid wind down of fossil fuel system and on a no regrets precautionary approach. So over to you, Chris, for the answer.
Please note that the scope of LGPS Central Joint Committee, as per its terms of reference, is a public forum for the administering authorities within the LGPS Central Pool to provide oversight of the delivery of the objectives of the pool, the delivery of client service, the delivery against the LGPS Central Business Case, and to deal with common investor issues. The data quoted in the Carbon Tracker report were taken from 2020 TCFD reports and reflect the predictions made in the Mercer climate change analysis at that time. Further TCFD reports have been issued since that time, which have utilised an updated model that Mercer has developed in partnership with Ortec Finance and Cambridge Econometrics. The reports acknowledged that climate scenario analysis remains a developing field which uses assumptions about inherently unpredictable matters over long time horizons. The outputs from the analysis were used as directional information on the sensitivity of the fund's portfolio to differentiate to different climate scenarios and considered in tandem with all the other factors which have the potential to impact on investment returns. Pooling partners are aware of the potentially devastating impacts of climate change and the need for the global economy to accelerate its transition to low carbon energy solutions. However, pooling partners have not reached a conclusion that divesting from fossil fuels will accelerate this transition. We recognise advice from our pooling company on the importance of 1, companies being owned by responsible investors that demand long-term thinking from corporate management and credible transition plans, and 2, the demand for fossil fuels within the economy, reducing and being replaced by demand for renewable energy. We are advised that focusing on only the supply of fossil fuels does not address the challenge. We recognise that climate change results in risks for investors, as indicated by recent climate scenario analysis, which illustrated that a successful transition and restricting global warming to 1.5 degrees Celsius is a much more favourable outcome than a failed transition in terms of investment performance. Pooling partners welcome the continued development of climate scenario analysis to support our management of the risks associated with climate change.
Thank you, Chris. So we now move on to the next substantive item, which is the Joint Committee Terms of Reference Review. So we have a presentation on this. So I can ask the... Okay, Chris, over to you.
Thank you, Chair. So this is a brief item on the Joint Committee's Terms of Reference. The purpose of this update is to endorse terms of reference and the protocol for dealing with public questions at meetings, and I'll be asking for the committee to approve the terms of reference as slightly amended. So under the terms of reference, they are to be reviewed annually to ensure they remain fit for purpose of the partnership between the partner funds. but due to staffing changes, the terms of reference were not reviewed in 2023, and the last formal review took place in January 2022. So this is a short report with some slight changes proposed. So back in January 2022, one of the changes proposed was that the partner fund shared objectives, which had been listed in the terms of reference, be removed, and instead a reference be included to the inter-parties inter-authority agreement, which listed the partner shared fund objectives. That was approved by the committee, subject to the inter-authority agreement being made publicly available. So we subsequently looked into whether that was feasible, and it's been determined that as that's not a public document, that it's not feasible to make that now publicly available, and instead it's proposed that we just again list the shared objectives in the terms of reference. So that's one proposal. And the second is a minor update, which is to refer to the clerk. Previously, the clerk has been referred to by name, but to avoid having to change the terms of reference every time there's a change in staff, it's proposed that it's just referred to the clerk in generic terms. So if members would consider.
Yep. So members, have you got any queries or questions on the terms of reference? No, doesn't look as though we have. So are you all happy to approve the revised terms of reference? Let's show of hands. Okay, so that's unanimous. Thank you. Again is an update on the Practitioners Advisory Forum and its working groups. Rachel Howe from West Midlands is going to present as current chair of the Practitioners Advisory Forum. So over to you, Rachel.
Thank you, Chair. So this is the biannual report to the Joint Committee noting the work undertaken by partner funds across the various working groups which support the delivery and governance of investment pooling. In accordance with the normal cycle of company activity, the company presented to partner funds in December the outline proposal for its 2024 business plan, due to be presented to shareholders at the company meeting at the end of the month. The business plan seeks to outline the company's future outlook in support of investment pooling, and partner funds are in the process of reviewing that draft in advance of the company meeting. Earlier this reporting period, LGPS Central Pool submitted the annual return to DLUC on projected asset transition and cost savings, noted at paragraph 4.1.2 in the paper. Work continues by the Finance Working Group to review the cost sharing principles. The original principles were drafted based on projected asset transition known at the commencement of pooling, and as part of good governance, it is good practice to review arrangements to ensure they remain applicable, fair and relevant as transitions and pooling continue to develop. At paragraph 4.1.4, we note the current position on fund launches, which seek to support the implementation of individual partner funds' investment strategies and strategic asset allocation, and these are noted at paragraph 4.1.5. More details on the products being developed, together with their performance, is outlined in item 11 on today's agenda as part of the company's presentation to committee. The Responsible Investment Working Group continues to meet on a quarterly basis to review current industry trends and developments on a range of environmental, social and governance issues. And this quarter, partners worked with the company to review stewardship themes on which the company engages. And these are again presented in detail on item 11 in today's agenda. The final item notes the work undertaken by the Central Pool on moving pooling forward, partly driven by the proposed LGPS next steps on investment consultation, together with the pool's desire to ensure the continued commitment and collaboration on pooling. As noted in the paper, the latest meeting of partner funds took place last week, and partners are finalising the outcomes on the vision of investment pooling, which will be shared in due course. Through you, Chair, I'm happy to take questions.
So, have any members got any questions for Rachel? Or we're asked to note this report, but by all means, if you have any queries or questions, speak up now. No? So is everybody happy to note that report? Yeah? Okay, that's unanimous. So we now move on to the next item, which is item 9, the pool risk register, which is on the papers. A high-level summary of the pool risk register which has been produced in conjunction with the partner funds and the company, is within the pack, which you've all had an opportunity to read. Again, I'm going to ask Rachel Howe from West Midlands to present as current chair of the governance working group. So Rachel, over to you again.
Thank you, Chair. So this is the regular report to Joint Committee outlining the potential impacts on the pool's ability to achieve its own and its statutory objectives. It should not be seen as a reflection of the risk assessment of either the company or individual partner funds, although there are inevitably some areas of common ground. The risk register reflects a forward-looking review, horizon scanning for changes which may impact or require change to the pool's operation and delivery model. As such, the risks are refreshed each quarter period, and the directional arrows reflect the trend on the risk assessment, pre and post actions and mitigations, noted as the pool's response column on the register at Appendix 1. The risk register this quarter has been updated to reflect the publication of the government's LGPS Next Steps on Investment Consultation Outcomes, which seeks increased asset transition and cost saving together with target allocations for specific assets. The report notes the potential for divergence across the industry on the outcomes of the consultation. Resource risk continues to be a focus to both the company and partner funds, noting the competition for recruitment of key knowledge and skills. Ongoing national and regulatory change continues to be a focus, and in addition to those noted in the report, partners will be aware that the pension regulator this month published the Single Code of Practice, which seeks to set standards of governance across UK pension funds and includes new sections on climate and investment governance, both of which will be of particular relevance to investment pooling and will continue to be a focus in partner funds' own governance. So through you, Chair, again, I'm happy to take questions.
Thank you, Rachel. So the risk register is within the papers. Has anybody got any questions or queries? No, it's first. You obviously made yourself very clear, Rachel. That's good. So we're asked to note the report and supporting appendix. Is committee happy to do that? Yep, thank you. So the next item is the Internal Audit Working Group update, which is a summary of the work of the Internal Audit Working Group. Debbie Harris and Leanne Teese of Staffordshire's Internal Audit Service are going to present to us. The presentation will discuss the Internal Audit Working Group's membership, aims, work and approach, and a summary of their work in recent years. It'll also be a discussion around the company's assurance framework, and finally a look ahead at future planned work. So, Debbie and Leanne, over to you, please.
Okay, so thank you, Chair, and thank you for inviting us here today as well. So this report provides the Joint Committee with details of the work of the Internal Audit Working Group, which is a working group of the PATH. So attached to the covering report is a presentation which we do have on screen. So that's also starting on page 35 of your pack as well. Happy just to refer to the pack numbers if you want. Okay, that's fine. Okay, yeah. So if members can turn to page 36 of their pack then, by way of introduction. So like the Chair was saying, my name is Deborah Harris. I'm the Chief Internal Auditor at Staffordshire County Council and also 2 other district councils within Staffordshire. I'm very much supported by Leanne Teese, who's a senior member of my internal audit team. We have 8 partner fund authority internal audit representatives, and we regularly attend meetings at least twice a year, but really it is as and when the agenda requires as well. It's very well attended and very well supported by all partner fund authorities, which is great. Turning to page 37 of your pack then, so in terms of the aims of the Internal Audit Working Group, well, the main aim really is to provide a collaborative approach to internal audit when we're providing assurance over the pensions pool arrangements, because as you can imagine, as internal audit sections, we all have our different ways of approaching audit work and also a methodology. So we very quickly realised that we needed to have one coordinated approach to that assurance going forward. So the other reason for the internal audit working group as well is to prevent duplication, because again, we didn't want it where we had lots of partner fund authorities asking questions by the internal audit teams and the external auditors. So it prevents duplication of effort and also costs. It also allows us to share information and also experiences and expertise across all partner fund authorities, and we found that it does work really, really well. So turning to page 38 of your pack in terms of what we actually do. Well, right at the beginning, when we formed the working group, we established and developed an audit assurance framework. Leanne was very instrumental in that, and that's mapping the pool risks across the 3 lines of defence. And within the presentation, in a few moments, Leanne will talk to you about that in a bit more detail. That's a very detailed piece of work that we undertook right at the beginning, and we've continued to maintain that over the course of the 4 years so far. And the outcome of that assurance framework is that we've developed a comprehensive internal audit programme. So annually we undertake 2 pieces of audit work within the themes of both governance and investment. And again, Leanne will share with you some of the details and findings of those pieces of work over the years in a moment or two. Also, we track recommendations that we make, and we also follow up on recommendations as a result of our internal audit work. But we also don't rely on just the collective internal audit work that we undertake. We also draw upon other sources of assurance. So we had the AAF 0120 report, the internal control report that the company provide to us, and again we meet as a internal audit working group and go through those findings and look at those exceptions and seek clarifications where we need to. There are also other sources of assurance that we also use as well, such as the summary of the annual Audit Risk and Compliance Committee report, as well as other statement of controls reports that we receive, which looks at the company's control environment. I also attend the governance working group, and I've also advised on the pool's risk register previously. So there's quite a lot of work, and we're quite actively involved across all streams within the pool. So turning to page 39 in terms of our approach. So like I say, we have a collective audit approach. We look at 2 areas annually in relation to governance and investments, and the scope within each of those 2 themes are quite broad. We do request that, and we have consultations with the head of the pension services back within our partner fund authorities, just to see what their main focus or any concerns they may have for the year. So we do have a lot of dialogue back within our own partner fund authorities. We complete standardised working papers and also produce a draft and final report that goes up through the chain, so everybody is aware of the work that we produce, the scope and also the findings. So very quickly moving on to page 40 of your pack and the audit process. So yes, the audit brief is produced by the lead authority for that year. That goes through the internal audit working group through a consultation process, and then either through to the governance working group or the investment working group, depending on which audit it is. And then the scope of work gets signed off by PAF. When the report is produced, again, it goes through the same stages, firstly through the internal audit working group and then through to PAF for final agreement. So again, everybody is aware of what's being produced and what we're looking at as we go throughout the year. So now I'm going to very quickly hand over to Leanne, who will share with you a bit more detail of the 4-year cyclical programme, and that starts on page 42 of your pack.
So if I can take you through the work that we've completed so far, as Deb has referred to, the IAWG complete 2 audits per year, one themed around governance and one around investment. Each audit's completed by a different partner fund, with the other partner funds placing reliance on the work. All partner funds undertake one audit every 4 years, hence why we operate a 4-year cycle. Since we came together as a group, we've completed work looking at both the overall arrangements of governance and investments, and targeted work looking at specific issues such as performance, budget setting, transitions and cost sharing. If you look at the current slide on page 42 of your pack, it shows the work completed so far and the opinions of the various reports. As you can see from the slide, audit work completed over the cycles highlighted a general trend of improvement in the control environment for both governance and investments. So on the next slide, which is page 43 of your pack, it shows some of the themes of the recommendations made as part of the investment audits over the last 4 years. Examples of recommendations made include updating various key documents, for example, terms of reference to reflect current decision-making delegations, and also inclusion of responsible investment as part of a product development protocol and development of responsible investment framework. The next slide, which is on page 44 of your pack, that just gives you some themes of the governance recommendations made over the last 4 years. Examples of recommendations made include agreement of the pool's administrative needs and development of the project support office, and agreement of a protocol for breach reporting. So if I can hand you back to Deb, she will then take you through the other forms of insurance reporting that we also look at.
Thanks, Leanne. So on page 45 of your pack then, this refers to the internal controls report that we look at, and this forms quite a big part of our assurance that we as a working group look at. We've recently received that report covering the period January 22 to December 22. So the group get together and we go through that in a lot of detail, looking at the various exceptions, and where appropriate, we ask for various clarifications from the company, which Leanne coordinates, and there's that dialogue back with the company to get various responses. Turning to page 46 of your pack. So what we wanted to do was just show you some of the level of detail in relation to our audit assurance framework that we've actually put together. And what this slide nicely shows you is where we all fit into that assurance model. So the assurance framework follows the 3 lines of defence, the first line being the management of controls. And here we're looking at the various governance structures, policies, procedures and management reporting. Some of those controls sit firmly within the partner fund authorities themselves, and others sit within the company. And we detail those within the framework, which Leanne will show you in a moment. The second line of defence is really the oversight, compliance and monitoring arrangements in place. And this is where the Joint Committee, the Shareholders Forum, PAF, and also our own individual pension committees come into play in terms of that oversight role. And that's a very important role to play. The third line of defence is us as internal audit. So the collective work that we do feeds into this, and then we feed back to our own pensions committee and also the PAF. And external audit also have a part to play. They look at the work that we do and also the internal control reports as well. So again, it all fits nicely into a nice jigsaw puzzle, as you can see from that diagram. So finally, I'm just going to hand you back to Leanne, who's going to just take you in just brief detail the assurance framework.
Okay, so the slide on page 47 of your pack shows an extract from the internal audit assurance framework, just so you can visualise how it looks. To assist with the audit process, the assurance framework has been created with the aim to map the various controls in place to address the risks identified as part of the pool's risk register. The first columns detail the risk as documented in the pool's risk register and the causes and impacts of these risks. The framework then goes on to document the management controls in place as part of the first line of defence and the oversight of the pool completed as part of the second line of defence. The controls operating as part of the first and second line of defence then will be included in any subsequent audit review, which is the third line of defence. Finally, the framework details who the assurance is provided to, including partner fund pension committees, audit committees and external audit. So finally, the next slide on page 48 of your pack. What does the year ahead look like for the internal audit working group? So in 23-24, Staffordshire have completing the investment audit, where scope covers a review of the management, procurement and monitoring arrangements. For this audit, we've already spent time at the company working with the investment team, as well as representatives from the pool. Wolverhampton will be taking on the responsibility for completing the governance audit, which will focus on communication within the governance arrangements of the pool. We've also updated the internal audit assurance framework to reflect recent changes to the pool's risk register. The framework's currently undergoing quality assurance, and we hope to have a full version to present to you at the next joint committee. There is a meeting of the IAWG next scheduled for the 8th of February, and as part of this meeting we'll be discussing the internal audit assurance framework, reviewing feedback from the company in relation to the AF 0120, and the group will also be discussing audit allocations for the next 4-year cycle and potential areas and timings for audits in 24-25. Representatives from IAWG will continue to attend the governance working group and provide support or advice to PATH where required. Are there any questions regarding the contents of the report?
Okay, so thank you very much, Debbie and Leanne. That's a fairly comprehensive report. Has anybody got any queries or questions on that? I can't. Yes.
Thank you, Chair. My query is there doesn't seem to be anything written within this report about liaising with the auditors for LGPS Central. I assume that takes place, but there's no reference to it in the report, which I find a bit surprising.
Well, we are the auditors for the pool, but we do liaise with the company as well, and we do get a summary of the internal auditors from the companies, what they produce as well. So, but we are the pool's auditors. We actually undertake the work. We are the auditors.
The internal auditors, you don't get to speak to them, the internal auditors of the company, do you?
No, but we do get a report from the company's internal auditors. So yes, we just get the internal controls report, and then any exceptions that we require clarifications from, we do go back through the company to get responses. So it's via the company that we get responses and communicate with their internal auditors.
Okay, thank you very much for that question. Yeah, thank you. So if there are no other queries or questions, we're asked to note and approve that item. Is everybody happy to do that? Yep, that's unanimous. Thank you. So finally, we're moving on to the LGPS Central Performance Update. We have with us today John Burns, the interim CEO, Gordon Ross, the Chief Investment Officer, and Patrick O'Hara, Responsible Investment Engagement Officer for the company. The presentation is going to focus primarily on pool fund performance and responsible investment. So, John, over to you to begin with to introduce the item.
Thank you, Chair. So I'll take the introduction, pass to Gordon for the investment piece. Patrick will pick up RI&E, and then we'll hand over to Joanne for some closing remarks. Just to briefly begin, so since the last committee, the DRUHC have concluded the consultation on investment pooling. And a couple of the key messages there really focused on accelerating pooling and moving public assets into the pool by 2025.
shaping the pools with a critical mass of around 50 billion in the short to medium term. In the short term, we will work with clients to facilitate these transitions and to meet these targets. Over the medium term, so I'm on slide 58 of the deck, sorry. Over the medium term, we're likely to see some legacy private markets funds mature and releasing funds for further investment through into the pool. Looking at the longer term, this offers us an opportunity to provide product which captures and improves the benefits of pooling through looking at larger, broader, deeper pools of investment. And the success of the pool is driven by investment scale, an ability to take advantage of long-term horizon views, and an ability to focus on an operational platform which is resilient and supporting the provision of high-quality investment services and performance. Moving over to slide 59. We need to offer you to be successful and provide the returns you need for your funds. We need to offer you the right products and services. And to date, we've launched a number of products over the years and offer clients support in RI&E and various advisory arrangements, all performing services which clients are probably not resourced to perform themselves. Moving to slide 60. Excuse me. Sorry, lost place here. Okay. So just continuing that, we need to build your confidence in our investment performance and service delivery through our transparent processes and our investment philosophy, alongside high quality service delivery. And finally, we'll be demonstrating value for money for the products we run for you in terms of performance, service and cost. Now turning to page 60, just looking back at the initial aims of pooling. When we started, our aims were there to offer benefits of scale, to improve governance, to reduce costs and provide capacity and capability. And how are we doing against those benchmarks? Clients have taken advantage of the pool. We're now at around 33% of assets which are pooled with us. Our services are provided through a regulated company, regulated by the FCA, and we garnered 77 million of savings already banked as we move towards the target in the future. And clients have also taken advantage of access to the investment opportunities not previously available, particularly in private markets, where sizable asset investments are undertaken. Our ambition for clients remains to continue our pooling journey and to capture the benefits of scale and leverage our strategic partnerships in the short to medium term. I'm happy to take any questions on anything I've spoken about so far before I pass over to Gordon.
Thank you, John. So, has any member got any questions they'd like to ask John? No? Oh. Yeah. Oh, Malcolm. Oh, sorry, I was looking everywhere but apart from you.
Yeah. I was wondering why there's no mention of the 2032-33 situation, where we had put in a report that's gone to the government as to what the expected total savings are, and that's not been highlighted in the interim chief executive's report. I'm just wondering if there is any focus given to that, apart from just saying, you know, that we bank 77 million at the moment, but really the aim is obviously to meet the savings that has been identified and sent to the government.
Okay, thank you. John.
Thank you, Mr. Cantallo. My omission for not mentioning that number, but the target still remains of over 300 million of savings that will be achieved by the pool by that deadline of 2032-33.
Yeah. Okay, thank you. So, John, do you want to carry on, or are we going to? Gordon's going to do the next bit, the investment update.
Thank you, John. Thank you, Thank you, Chair. If we turn to the next slide, which I believe, if my maths is right, is slide 62, you can see an overview of LGPS Central's products. As always with this, we split them into the three areas of the passive funds, active funds, and the private market funds. You can see on the table on the right-hand side how these have grown over time. So we have nearly 8.3 billion under management in the passive funds. These are there to run against an index. They mirror an index. They are not there to add value or alpha. They replicate the market. You'll see that in the performance on the slide in a minute. The active funds, for the majority, are outsourced to third-party managers. We choose these through our procurement process. They are monitored by the various teams internally and have grown over time to nearly 9 billion, as you can see. And then over the last 2.5 years, the private markets have been an area which the partner funds have added more assets to. We have created more funds in response to that. And we now have 4 private equity funds, private credit funds, 3 infrastructure funds. These numbers are all as at the end of November. But if we go into December and to the early part of 2024, we've added a direct property fund, which again is private markets, and we are looking to launch an indirect property fund, which should be done and launched by the end of the first quarter. So again, we are continuing to increase the menu of funds that partner funds can allocate to. On slide 63, it's just a backdrop of, since we last met, what the macroeconomic background is. As everybody is very much aware, it's been a period of inflation. It's been a period of interest rates being raised by many of the central banks around the world. Inflation is beginning to tail off. It is still the beast yet to be conquered. The central banks have stopped, for the most part, raising rates. They were raised very dramatically in 2022-23 to the tune of 5% in some areas. This has not had a great effect on economies. The markets were anticipating recessions in many of the world economies, the major economies. This to date has not happened, although there are some pressures showing that growth has declined. So the central banks are balancing the fight against inflation, the fight to retain employment at reasonable levels and prevent unemployment, but more importantly, trying to make sure that economic growth is retained. Economic growth at the moment is very low, although that it is not officially in recessions in many of the central markets and central economies. The US continues to do very well, predominantly at the result of a lot of stimulus helping the consumer through COVID, which has continued with the expense of the consumer supporting the economy. Things may change by the next time I sit here and talk to you, but at the moment the markets seem to be looking for rates to come down, economies to be stabilised, and the central banks to have control. However, there are certain clouds on the horizon which may make this a slightly more volatile period to continue on the volatility you saw at the end of last year. So with that, on slide 64, go on to the performance. Again, just to reiterate the 2 areas of this table, the top lines are these passive funds. You can see that they're rated green, as you would expect, because they replicate the index. They're looking, we measure them on a tracking error, which is a means of volatility. We expect them to follow the index, not fully, as in buy every stock, but replicate them to a degree that the tracking error or the margin against the index is very minimal. That has been succeeded, as you can see, by the traffic lights of all being green, which means they're all within their tracking level or volatility targets. If I then go to the lower part of this table, again, bearing in mind these are to the 30th of November, you're still seeing on the middle the rolling 3-year period, and then benchmark against the benchmark and against target. And since inception of the fund, obviously the funds have grown over time. You can see the inception dates on the charts here. Where you have an amber, that implies that we are above the benchmark but not meeting the target. Where it is red, it implies that it's not meeting either the target or benchmark. The gaps are predominantly because some of the funds are not yet 3 years old, therefore they cannot be measured on a 3-year rolling basis. I would add that since these numbers go in December was a very good month for all the funds, and 2023 as a whole was a very good good market or good environment for both bond and equity funds, whereby we have for the year 5 out of the 8 funds you see here were above their benchmark, so would be amber. And we have 6 of the 8 funds actually above their benchmark for the last quarter of 2023. So although you're seeing red and amber here, the direction of travel is improving greatly, and that has continued into January of this year. If I turn on to the next slide, looking at the overview, as I said, we are continuing to grow the private market allocations. We have 13 strategies launched to date, with more carrying on into 2024. The opportunities here are diversification for partner funds allocations, mitigating risk, and into attractive asset classes. We have a new vintages for 24 of both private credit, private equity, and indirect residential, as I've mentioned already. And then this increases the remit, so we are building the balance. So there is a complete spectrum of both public and private market opportunities for allocations. Infrastructure funds are open-ended. This allows the commitments of capital to be done on a regular basis, which is typically quarterly, and therefore this is the ability to continually invest in funds that are there. And as I said, the UK direct property has been recently launched, and this will give the opportunity over time for legacy portfolios to be potentially transitioned into this. For the direct property, we have an external manager who is looking after the direct property allocations. On the next slide, the performance of the private markets. Again, you can the same red, amber, green traffic lights. The numbers you can see here are sporadic. This is primarily because it takes a while for committed assets to be invested. So the funds will identify an area they want to commit to. We will create the fund, and then over time, those commitments are actually invested. This can take up to 2 to 3 years. So it takes a while for performance numbers to be meaningful, because you may only have a very small proportion of the funds allocate, typically 20 or 30%. But normally by about 18 months after the launch, you get something that is meaningful, which is why, and as you can see, the older version, the equity partnerships of 2018 and the co-investments of 2018 have returns which are again both above their benchmark and indeed above their target. Going on to product development, on the next slide, we are looking to launch various products over the next quarter and this year. The imminent one is a buy and maintain credit fund. The investment case has been progressed, and we're about to go out to due diligence to choose a manager, and the launch is expected in the first quarter of this year. The private equity 2024 vintage again is in process with the same time frame for launch. As I said, infrastructure is an open-ended, so these are quarterly windows that partner funds can allocate to. And then we're looking for our private credit funds to have the business case and investment case taken through internal and partner fund governance over the next 2 quarters. So our priorities for 2024, obviously continual collaboration with partner funds to make sure we are understanding exactly where their strategic asset allocation is, what their investment requirements are, and where possible produce funds or work in collaboration to find or identify areas that we can solve, provide solutions for these allocations. We continue to review our external manager procurement process. We're trying to make it more nimble. As time goes on, we'll be more likely to add managers rather than create new products. Managers are obviously monitored for their own performance, how they fit into the solution. And as time goes on, some of these mandates and funds will change shape and morph into different opportunities as partner fund requirements change. And we can make these, as John referred to, deeper and bigger pools where we find solutions that work across the aggregation. And again, we continue to make sure we have long-term views on these funds to make sure they are weatherproofed and are suitable for all investment occasions. And with that, any questions?
Okay, so thank you for that Gordon. So, yes.
Thank you. On the slide where you were giving the public market performance, 7 out of the 8 active funds are either red or orange, meaning they are behind their performance targets. 7 out of 8. So what assurance can you provide this committee about your ability, not personally, obviously, the ability to deliver the performance in line with your own targets?
Thank you for that. As I said, this is to the end of November. Performance has improved. Performance continues to improve. Bear in mind that of these, 3 of these are sustainable funds. They would normally be into one fund. These are separate areas. These sustainable funds will move very much in tandem with each other because of the style bias. We believe the teams monitor the structure of the portfolio. They monitor the managers, and over the long term, we believe the managers we have are correct. As you may or may not know, we are currently adding a 4th manager to the Global Equity Fund, and we are replacing a manager in the Global Emerging Equity Fund. So if you take those 2 funds to the end of the year, we would consider that the Global Equity Fund will be one of our benchmarks. It is over the rolling 3 years outperforming its benchmark, and it's within 13 basis points, 13 basis points of its target, which is obviously an improvement on the numbers you see here. So we believe that over time this performance will continue.
Thank you. So then I presume then we can look forward in the very near future then to the emission of the amber and the red and it all being in green.
I can never promise the future, but this is our intention to get better.
Yeah, thank you for that question. Okay. Any other questions or queries? Yes, Malcolm.
Thank you, Chair. Mine is a question concerning the new property fund. You mentioned that it was indirect. What does that actually mean?
So we have 2 property funds. One is a direct property and one is indirect. The direct is literally investing in buildings we choose, or the indirect is investing in funds that invest directly. So it's a third-party investment.
Okay, so if there are, yes, please, yeah.
Thank you, Chair. Gordon, if I may, just on inflation, just for my clarity, it says here, headline inflation has declined, but core inflation is generally being more stubborn. I can't quite answer in my mind, what do we count as core inflation?
So core is when you take out some of the things that are more movable. So it tends to be excluding things like fuel and energy costs. So it would be predominantly food costs, service costs, and those tend to be stickier because they're obviously a longer lag of anything that government can do to cure it.
Okay, thank you for that. I just couldn't quite fathom out in my mind. And the key question on slide 12 has been asked, so I won't push you on that. But part of your reply was that we're replacing managers. Could you embellish a little bit more on that one?
So when we go and create a mandate and a fund that we're looking to, the partner funds that have spoken about, we're trying to allocate to a piece of their strategic asset allocation. So for instance, the Emerging Equity Fund, we'll choose the managers. We choose the managers through a process which we believe to be very rigorous, and we provide the managers we believe to be the best managers for what we're trying to achieve. Over time, however, they may not perform well. There may be change of corporate ownership. There may be change of teams. There are certain things that a manager does that to us is a red flag, which means that the reason we chose them has changed. Typically, it could be a manager, portfolio manager within that team leaving. In this case, it's the corporate structure. The company we hired has been taken over by another company, and the team actually has been split. So it's not what we chose. Therefore, we're looking to and have actually procured a new manager. And what we then do is make sure that the portfolio they would put, we test it against the existing portfolio to make sure it's a good fit, and therefore we'll fire one manager and reallocate to another manager.
Okay.
So thank you, Gordon. Thank you, Chair.
John.
Chairman, may I just kind of come back on the first question and just supporting what Gordon was saying about investment. I think the success of a long-term investment manager is really founded on its philosophy, its processes, and its checks and balances, and that's what delivers the investment performance over the long term. Markets will be volatile, go up and down, but in the long term, we need to track that trend as the portfolios increase in value. So what we do, and we hope our clients and partner funds take pride in what we do, is the fact that we have a sound philosophy, we have effective and strong sound processes, which give us the best opportunity to achieve the results and the performance that we need. There will be ups and downs. There will be things that don't go right occasionally. Then do we have the checks and balances to respond to those? And I believe, yes, we do. And I think that's what we should be giving great credibility to give us the confidence that we will achieve the results in the future. Gordon said nothing's guaranteed. We can't guarantee performance, but putting the processes in place makes sure that we do have the best opportunity to achieve those returns.
Thank you. Thank you, John. Would you say 5 or 6 years is a reasonable period to expect these managers to perform from inception?
Please.
The contracts tend to be rolling 3 to 5 years. The industry norm would be a rolling 3-year performance, because again, inception ends up being a long time ago. So it tends to be that rolling 3-year period.
Thank you. Thank you, John. So have we got any other questions or queries? No, we haven't. So I believe it's now, Patrick, you're presenting on the responsible investment.
Yes, thank you very much. I'd like to give you an update on our areas of focus in 2023 and our priorities for 2024. I'm happy to take any questions on our work more generally, so feel free to stop me or ask questions at the end. So moving on, right, so just to give you an update on recruitment, we had some turnover in the team this year, but I'm very pleased to report that we've recruited strongly. Sheila Stefani has joined as Head of Stewardship. She has many years of stewardship experience with TPT, and prior to that with the Church of England, working with the Church Pensions Board and the Church Commissioners. And we've recruited Edward Baker to the role of RI Manager Net Zero. So he'll focus on the implementation of our net zero strategy. He joined us from the UN Principles for Responsible Investment, where he was head of climate policy. And we've managed to retain key individuals in the team. Basha Sally, who heads up our integration work and our climate reporting, and the junior members of the team have developed their skill set and are ready to make a bigger contribution to the work of the team as we go forward. So I'm very happy with the team structure as it stands at the moment. As mentioned, we launched our net zero strategy in 2023, and we received very positive feedback, both from our external managers who we've sat down with to socialise the strategy with, and also from the RI media more generally. And some, we attempted for this to be a policy that was, and strategy that was fit for purpose for LGPS Central, but also building on what others had done. We feel like we've achieved that. There's some innovative targets in there, and it's all within our current mandates and our current approach to responsible investment. So we'll work on the implementation of that during the course of the year. So moving on to the next slide, please. Thank you. So we reviewed our climate risk monitoring service. We delivered on that to all partner funds this year. There was a lot of development work to make that more of a sustainable service going forwards. And so all of that development work was done within the team, which is quite unusual for an RI function at an asset management business. There'd be quite a lot of IT involvement in that, but we did all that within the team. Now, that did delay the production of the reports a little bit, but there's no development work or significant development work planned for this year. So we'll be back to our normal, regular programme of delivery for that during 2024. But we have enhanced the metrics to make them more in line with our net zero strategy. We've included financed emissions and scope 3 emissions in there, and we've also included the analysis of sovereign debt, and we will extend that to include private markets during 2024, which will be a key area for us. So moving on to the next slide, please. Thank you. So building on some of the feedback we've had from partner funds, we've developed a new engagement tracker, which is more output and impact focused. And that will help us to report more along those lines going forward in terms of our stewardship activities, what change we're bringing about and what impact stewardship is having on the behaviour of companies in the portfolio. Now, we're engaging with these companies along with other investors, so we won't claim to be the sole change maker in any of those engagements, but we can give you assurance that stewardship more broadly is working and having the desired impact. And indeed where we feel it's not with individual companies. So watch this space in 2024 around that reporting. So moving on to the next slide, please. And building on from that, again, we've refreshed our stewardship themes. They came to the end of their 3-year cycle, and we've reviewed those in conjunction with the partner funds to reflect the fact that we want to make sure that we're able to have an impactful and successful stewardship program. So the themes have to be key areas of focus for responsible investors, but also things where we think we can influence and bring about change. So we'll keep focus on climate change. We'll introduce an increased focus on natural capital. We've always engaged on deforestation, but natural capital is a key area for investors now. So that's going to be one of our key areas of focus, and we will continue to focus on human rights. We also want to maintain some bandwidth within the team to focus on sensitive and topical issues that arise in the portfolio. So every so often there will be negative press around a company in the portfolio that we feel we'll need to engage with the company on. Or there may be for example, in the mining industry, there may be a health and safety issue or accident that has resulted in fatalities where we feel we need to engage with the company. So we will have more portfolio focused engagements, not just a thematic approach. And that's a key area again for us to achieve impact. Moving on to the next slide, please. Thank you. And so, again, these are some key engagements for us during 2023 and key areas of success. They cover a range of areas: human rights, climate change, tax is represented there, as well as senior management remuneration. We've seen some change there from SocGen, who have released their new climate strategy, which encompasses net zero targets and a transition plan and an exit from fossil fuels. We expect a similar plan from Barclays this year. We've been engaging closely with them on that. Shell as well, we're engaging with ahead of the AGM season this year. Shell will release their new transition plan. And we've been engaging with other investors, alongside other investors with BP, as a result of the changes they made to their transition plan last year, and also around the appointment of their new CEO. And BHP Billiton is a company that we're engaging with on human rights. Experian is a company that we've engaged with on tax, but we feel that there's been sufficient progress there. They're likely to come off that collaborative engagement program this year. Move on to the next slide, please. Every year we fill out the UN PRI survey, which encapsulates our responsible investment approach and activities. Other asset owners and other asset managers across the responsible investment industry do this, and the UN PRI score the results of that. We've had the results of our report back, and we've scored well above the UN PRI average. The line there on the chart, those thin blue lines, vertical lines, indicate where the average is, and you can see our score 95, 91, 91 there, well above the average for the sector. And we received 5 stars out of 6 for those modules. There's one at the bottom there, which is around confidence building measures, which is really around external sort of activities across the industry, which we deliberately haven't focused on. We focused more on partner funds and internally within LGPS Central, but we will look at that next year and see how we can score more, score better on that module going forwards. But we were very pleased with those results. Moving on to the next slide, please. So just to summarise there again some of the activities. I won't go through all of those, but we have developed and established our RI Champions Network this year. So this is really an effort to identify in each investment team colleagues who are going to be a champion for responsible investment that we can work with to embed and integrate ESG and RI across the business better. We want it to be core. We consider it to be core, but there's things that we can do more, I think, to get support for the team across the company. So we've had the terms of reference approved by the investment committee, and we've now established the membership of that. So we'll have the first meeting of that Champions Network in Q1 this year. We delivered our RI Summit to you in 2023, and we're working on the 2024 Summit. And we'll continue to work with you on your TCFD reporting and your stewardship code reports as you see fit. So I won't dwell on any of, I won't read through that whole list, but if there are any of those areas that you want to ask me about, feel free to do so.
Thank you, Patrick. Clearly some good work going on there, and there's always
There's
more.
one more slide.
Okay.
Sorry. Yeah, moving on to the next one. And this is just priorities for next year. So as I said, we'll have a renewed focus on private markets, both in terms of our climate reporting, but in terms of our monitoring of managers and our engagement with managers on their net zero strategies. We are focused on the regulatory developments, which came up in the question earlier, and we're working across, we have a cross-team working group on that. They're getting assistance from our legal and compliance team as well as the investment teams. And we will release our sustainable investment monitoring service, which is very similar to the climate risk reporting that we do for the partner funds already, but it's focused on other ESG factors beyond climate change. You know, we consider that we are very climate focused, and there are lots of other ESG risks that and issues that we should focus on more. And then the implementation of the net zero strategy, which is going to be a big piece of work for us this year. And we're working on our dashboard that will enable us to report progress in terms of our emissions. And we're also extending that work to focus on the operational emissions of the company, so that we plan to also launch a net zero strategy for the company. And that's all from me. As I said, happy to answer any questions.
Thank you, Patrick. Please.
Thank you, Chair, and thank you, Patrick. I have to say, an impressive scorecard, 5 out of 6, and it's ironic that the one that just failed to hit that 5-star barrier was the confidence building measures, but a vital one. I'm sure you, so we wish you well with that. And really, just to say on behalf of Staffordshire Pension Fund, we do welcome the enhancements and the measures of success and the effectiveness of engagement. So thank you. Good report. Thank you, Chair.
Have we got any other questions? Well, the Task Force on Climate Financial Disclosures, we've got 5 out of our funds who have signed up to it. Are we likely to get the others signed up soon?
That's the stewardship code, the 5 out of 8. The TCFD reporting is done by everybody, including Central. But I understand there are plans afoot for the other partner funds to start stewardship code reporting this year.
So, yeah, a very welcome report. I mean, as I said earlier, some impressive achievements. And it's a huge focus, and well done. Has anybody else got any other questions? No? No? Right. Thank you, Patrick.
Thank you.
Now, Gordon.
Sorry, Chair, I did omit to answer the question from the last meeting.
Oh yes,
So
of course.
in answer to that question, and we have a slide. If I can do the maths, it's slide 27 mine, but I think it's 71 on the pack. And we've split down the public market sub-funds. The saving comes to about 22 million in value at the end of 23. And we split it down and further into equity and into bonds. This does not include the private market funds, and it is an amount against their index. So the question was, how much have we outperformed the indexes? So that's the amalgamation only on the public market funds, and we can include this going forward, and we'll include private markets as and when those numbers are sensible.
Thank you. Thanks. So, John, do you want to add anything else, or do you want?
I've finished. I'll hand over to
you, Joanne.
Joanne, yes.
Okay,
thank you.
that's fine.
Well, thank you very much. And I think what you've heard from John and Patrick and Gordon is an overview of just some of the work that the company has been undertaking on behalf of partner funds. And so I think in concluding this presentation from the company, I just really want to start and end, if you like, by thanking partner funds for your continued support, because the progress that we make, and hopefully you can see that we have made lots of progress, in particular on areas such as responsible investment, which remains absolutely core to what we do and core to our beliefs and your beliefs, is really about us working together in partnership, because I think we have seen that real progress investing across that very broad spectrum of assets to make sure that we can meet partner funds' needs. And I was particularly pleased to see that property fund, that indirect property fund, Malcolm, to your point, launched at the back end of last year, and the further work going on around the direct property fund. And I think, as I said, that progress that we've heard about today is really testament to that collaborative working, and I think that's absolutely essential to our continued success. Because taking a step back, and John outlined at the beginning of his presentation some of the sort of macro backdrop, not the macroeconomic backdrop, Gordon touched on that, but the macro sort of political backdrop to our work on pooling. I think that 2024, 2025 is going to be a really big year for us as we step into that new financial year. And Rachel also, hinted in her presentation about some of the work that's gone on around in response to and in the run-up to the government's work on the future of pooling and what that needs to look like. So as that shapes up, we will be thinking very hard as a board, as a company, alongside you with what those, what the information coming out of government means for us and means for our future together as a pool, so we can continue to deliver for you in this context as our clients, and as we see you again as our shareholders, so that we can deliver for you together. So that's really all I wanted to say by way of closing remarks, but really to say thank you again for all your support to us. It's absolutely valued and absolutely essential, so thank you.
Thank you, Joanne. Has anybody got any final queries or questions? No, I think we've had a fairly comprehensive report. Thanks very much. So that concludes today's official meeting. It's the date of the next meeting is expected to be in this summer, and it'll be determined after the meeting. I think that the YouTube video, the recording now can be ceased, and once that's done, I'll confirm. Has it ceased?